Welcome back to the Retire in BC podcast, where we help you build, protect, and enjoy your wealth right here in beautiful BC. I'm Arnold Majel, joined as always by Ben. Today we're talking about a topic that hits close to home for a lot of parents and grandparents: saving for a child's education using an RESP, a registered education savings plan. Whether you've got a newborn or a teenager or grandkids on the way, understanding how RESPs work can make a real difference in helping them graduate without mountains of debt. We'll break down how the plans work, how to make the most of government grants, and a few common mistakes to avoid, and maybe some tricks to take advantage of. Let's get into it.
Yeah, for sure. And so today's like mostly about the education savings plan, or it's all about that. But more broadly speaking, just kind of how to save for a kid's education, how to help fund that, things like that. Obviously, because you helped out on us. But for our listeners, what my parents did for me and my siblings was that you guys offered to basically pay for half of our schooling. And so we were responsible for coming up with our half, meaning that we've got some skin in the game. I'm not going to go get some degree that's, useless or I'm not going to waste the money or waste my time there. Not that every child would do that otherwise, but just it was a nice way of making sure that we had some skin in the game, like I say. And then you guys covered the other half, which allowed us to pursue what we wanted, not go into mountains of debt, like you say. I ended up with a small student loan, but nothing too crazy. And certainly, like I'm sure that at the time I thanked you guys for having done that, but I don't really know if more recently or as a true adult, if I've really ever sincerely expressed my gratitude for what you guys did for us. So I do really, really appreciate that you guys were able to do that. I don't know if all of that came from an RESP. Certainly some of it did. Just wanted to talk about that tool and how it can slot in to do something like that for our listeners, kids, grandkids, friends, so on and so forth.
Well, you're super welcome, Ben. I mean, it worked out. Um, you may not remember actually what we actually did was the first semester we covered 100%.
That's right. Yeah.
And then after that it was 50-50. And the idea behind that was we wanted to encourage each of you to go to post-secondary, and that worked out. Interesting thing is, and this is it might be helpful for our listeners. The interesting thing is we noticed a distinct pattern about your and the other kids' willingness to buy used books between the first semester where it was all being paid and the second semester when all of a sudden you had to come up with half the money. It was kind of interesting. It was a lesson learned, right?
That one was always tricky though, because sometimes you had to buy the new books. You really didn't have a choice because the professors would always refer
Right,
to question
right,
5C,
right,
and if you had an older edition, you were just hooped. Right.
right,
So,
right,
so
right.
yes, I hear you. It teaches some fiscal responsibility. The textbooks may or may not be the best example of that, but
One
yeah, the
one
point
other
stands.
one other interesting thing that our listeners may be interested in, well, actually, and you too. I don't think I've ever told you this. Uh, when about 5 years, so Ben's oldest sibling is Catherine, and when she was about 5 years before post-secondary, I did this exercise that I'd been getting clients to do, where we sort of fast forward for the rest of their life and looked at it today, 5 years from now, 5 years from then, 5 years from then, and just sort of what things were happening at those times. How old were their kids? How old were their parents? What kinds of things should we be worrying about? And so I did that same exercise on me, on Sharon and I, and and all of a sudden it hit me. We had been saving in an RESP, but we hadn't been maxing it out. Money's not unlimited, and so we had definitely been setting aside a good chunk. But all of a sudden it hit me that within 5 years we're going to have a kid going to post-secondary. We needed to have more money in there, and so I actually went back to my wife and said we need to increase. I think it was a five-fold increase in the education savings, because there's this free grant money there that we want to take advantage of. And I'm so glad we did it.
Hmm.
And I've done that with other clients before when they realize sort of this tight timeline. sometimes it's a good reminder to sort of
Yeah.
increase the amount of
Well, and
savings.
it sneaks up on you like that too, right? Like I know
Exactly.
certainly with our clients, if they're starting with a newborn or 1 or 2 year old, the monthly amount you got to put in there to max it out, not that huge. If
That's
you wait
right.
till they're 10 or 12 or whatever, right?
Yeah,
It really
yeah.
ramps up. So let's get into the RESP basics, education savings plan, what it is. Obviously, the why is to help with post-secondary education. But yeah, at the end of the day, it's just a different account type like TFSA, RSP, whatever. So within the plan, obviously, you can invest the funds. And the gist of it is that you're going to name a beneficiary, namely the child, or even multiple in one plan, which we'll talk about in a minute. And you're going to designate that plan, or at least the grant and growth money in the plan for their education. As you put money in, the government's going to match some of that and put some additional money in on the kid's behalf, right? That
Now,
eventually,
actually,
yeah, go
since
ahead.
you're mentioning the grants, one thing, if we've got any older listeners out there, uh, it used to be RESPs were a terrible deal. In fact, when I first got into the business, I told lots of people, don't use an RESP. They are terrible. They lock up the money. It's hard to get at. And if you don't use it, you got to give up most of the grant and growth to the government. They were brutal. And it wasn't until 1998, actually, that they added in the grant money and they started making it easier to take the money out of it. And then the switch just turned on and it made a ton of sense. But prior to that, we were telling people to use in trust accounts instead of RESPs. And so if you're an older listener out there and have a bad attitude about RESPs, it's understandable because they were at one point terrible. But today, in fact, actually, starting in 1998, they became great. And the interesting thing was just about every year or two, or it's slowed down now, every few
Mhm.
years, they've actually improved it and made enhancements, made it easier to get the money out and offered more benefits.
For sure. Yeah. And so we'll talk more about that grant money in just a second and get into the details. Before we take a look at that, though, I just wanted to highlight like 2 points here. Number one is that it's not only the parents that can set up the account, other people can. Like if grandparents wanted to set up a RESP for the grandkids, or even, relatives, if it was a friend, you're allowed to do that. You just need basically you need the parents or the primary caregivers to sign off on getting that grant money, right? So they just have a little bit of control over, not that this is likely, but if 10 different people have opened an account and they're, it just gives them some degree of control over it. And then number two is that you can open an individual RESP, so each one is for each beneficiary, or what you can do is open it up as a family RESP, so that now under one plan, you've got multiple beneficiaries that are siblings of one another. That's beneficial because then the money's going in for one beneficiary at a time, but if one of them doesn't end up going to school, maybe a different sibling can pull the grant money out and use it for their education. So there is some flexibility there as well.
Yeah, no, I agree. The more that you can't always open up a family RESP, but if you can, that's the better way to go. At least in most cases, it just allows a lot more flexibility, and we've seen that happen. I guess actually as part of that, it's also worth noting you kind of you mentioned it, but you're not restricted to just one RESP. You can have multiple RESPs. We've got a number of situations where parents have an RESP for their kids, and then the grandparents, for whatever reason, have chosen to open up a separate one, and that's okay. There's nothing wrong with that. Or you can, instead, if the grandparents, in some cases, and we have this too, rather than opening up a second RESP, it's simpler for them to just give the money once a year. They give a small amount of money to their kids who put it into their kids' RESP.
Mhm,
So
mhm.
lots of different ways you can do it. That's what we're here for, to help you, guide you, and figure out the best way to do it.
Yeah, for sure. And like that main benefit that we've talked about, it is that grant money that you put it in, the government matches some of your contributions and puts it into the plan to help fund for that education. So how that works is basically the money you put in, the government is going to match 20% of that in most cases. Uh, and then it's kind of limited to in any given year that the allocation for that year is they'll match $500. meaning you have to put 2.5 grand in, 2,500 per beneficiary, right, or per child in the plan, right? So they are going to do that up to a lifetime maximum. The government will put in 7,200 per beneficiary, and basically that's available in the years between when they're 0 and turning 17. So you've got 18 years there. Again, if you start when they're young, that's pretty reasonable to do. You'd be looking at, doing 170 to 210 bucks a month, something like that. Put it in, you'll get the maximum grant for each kid. And then if you start later, well, then yeah, you have to ramp up. If you have half as much time, you got to put in twice as much money, right?
So
To max it out.
I think it's worth commenting that so the what would generate the maximum amount of grant in any given year is 2,500. But if you actually just do 2,000 over the course of the 17 years, or actually, I guess it's 18 years because it's your 0 to age 17. Over the course of that 18 years, you will max it out. If you put in the 2,500 instead of 2,000, you'll actually max it out a little bit early, which then you can stop making contributions, or you can keep making contributions, not get any more grant money, but you're still adding to the
Yeah,
education fund for the
yeah.
benefit of
Well,
the kid.
or
It
like,
just gives you some flexibility.
yeah. So said another way is that if you put in that maximum 2,500 a year, you max it out by the time they hit 14 or 15.
Right,
If you put in less, the 2,000, then you're maxing it out at 17, 18. Still good, still a great thing to do.
right,
Could have
right,
been maxed a little bit early. So there is
right.
some flexibility there. Other than that, so I had said that there's a 20% match in most cases. In some cases, there's even going to be additional grant money there. If there's a lower or middle income earning family, just there's an additional grant that goes in. As well as there might be the Canada Learning Bond. It's just a different portion that it's not based on matching what you put in. It's just a little bonus that the government might put in on your behalf. Again, not applicable to most people, but that is available for some lower income families that typically we just apply, on one sheet of paper, apply for the Canada Learning Bond and the Education Savings Grant, apply for everything, and then kind of you get what you get. But just thought I'd mention that as well. And other than that, we mentioned, you can put in 2,000 or 2,500 a year or whatever. There is also, that's for this year. But if your child had earned some last year that you didn't take advantage of, well, there is basically 1 year's catch-up room available. You can each year catch up on, or you can do this year's 2,500 and catch up on last year's 2,500 as well, right? So there is that catch-up mechanic to be able to get it in if you are starting a little bit later.
But there does come a point at which it becomes too late. If you haven't been contributing, there comes a point at which you just can't get caught up. So we do try to monitor that and make sure that we're always in that position where you can catch up. Like the other thing to comment on there is the other benefit that's inside the RESP is so. A lot of times people say, well, do I get a tax receipt for this contribution? No, you don't, because you don't get to deduct it. What happens is you get that 20% free grant money instead, or it goes into the plan. But the other benefit that you get from it is the money inside that plan now is growing first on a tax deferred basis. So it's growing inside the plan, sort of like an RRSP. It's growing and you're not paying tax on it. It's going to get taxed when it gets pulled out. But it's not going to get taxed. It's probably not going to get taxed at your rate, which is likely a higher rate. It's going to get taxed at your kid's rate, which will probably be 0. Or, I think the most we've ever had, we a couple of times we've had kids that just started earning money early, and they did end up getting taxed at 20%. Well, you got 20% to begin with. You got tax-free growth, and instead of you paying tax on that growth at 30 or 40%, your kid's paying tax at 20%.
Or 0, 0 or 20.
Or 0, ideally 0. And most of the time, the parents I talk to say, I've already told my kids I'm going to pay that tax for them. So, but it's a good deal all around.
Oh, they're phenomenal, yeah, and I love them. Like, I mean, we talk about them as education tools, but I also just think of it as kind of an estate tool. It's a extremely efficient way to get money into the hands of the next generation. And when you're making those withdrawals, it's not as though they have to spend all of that money on tuition, or they have to spend all of that money on tuition and room and board, or anything like that, they are allowed, as long as they're going to school, some post-secondary institution, they can pull out the money and they can spend it on basically whatever they want, just as long as it's reasonable. It's not an outrageous amount that you've pulled out of the plan in a year, which in most cases they're not going to be large enough to do that anyhow. So basically, yeah, you just pull it out. You need the proof of enrollment for the student, and then they can spend it on food or on a laptop or on their tuition or whatever. We don't need the receipts.
or a
We just
car.
need the proof of enrollment or a car.
Or a
Yeah.
car. Yeah, yeah, yeah. In fact, I don't believe, I know there is that reasonable definition in the rule book, but I don't, I'm actually 99.5% certain that we have never ever had any child ever audited on that amount. And we've taken out, I don't know, maybe the biggest chunk in a year was probably 40 grand or 50 grand. Um, just yeah, it's just never been questioned.
Mhm.
But yeah, there is a reasonable rule. So I guess if you had 200 grand in there because you bought a stock that skyrocketed, I suppose it's possible. But realistically, we've just never had anybody
Yeah.
audited there.
Yeah. Well, and I should mention when you're making those withdrawals, we kind of internally break those down into two different big categories. One is, okay, you've got your original contributions that you put into the plan. Those are yours to do with what you want. Now, we still typically want a proof of enrollment to get those back to you. But the other component then is, okay, the government has put in their grant money and the plan has grown over time thanks to savvy investing. So typically we're lumping that grant and growth money together. That's what ostensibly has to be used for the student's benefit, right? So again, as long as it's reasonable, that ends up being taxed to them. And so to pull it out and use it for yourself, that's not really how they're supposed to work. They need to go and be used
Right,
for the student's
right.
benefit.
Yeah, yeah.
Now, that being said, if for their benefit, that could mean that the parent is charging them room and board to stay at home or something along those lines as well, right?
Yeah, yeah. So they're very, very flexible and like you said, Dan, I mean, what we're always trying to do is walk that fine line between taking out as much of that grant growth combination, that part that's taxable, as much of it as we possibly can without putting the child in a taxable situation. Part of the reason for that is embedded in that is the government grant component. And that's the component that if the child stopped going to university or post-secondary, you'd have to pay back to the government. So we want to pull it out as fast as we possibly can, but not so fast that it's causing a tax problem, right? So it's always that fine line walking between it, and it's 110% true what you said there about you can take that those contributions out and do whatever you want with them. In fact, with your education money, we pulled the grant out and I bought my Harley. So
Not the grant. You pulled the contributions out.
we pulled the contributions out. But again, the rules of it are such that to do that tax effectively, the kids had to be at least one kid had to be going to post-secondary. And with that, we could pull that money out. We could take out what made sense of that grant growth combination, and we could pull out all of the contributions at the same time. And then I could spend that. And now that left us with not enough money to cover off the kids' education, but then we covered that off with cash flow later on. So again, just sort of highlighting the absolute, I mean, it's not total flexibility. You can't just do whatever you want. There are rules, but they're pretty darn flexible, and you can do a lot of really cool, interesting things with them.
Yeah, well, and two things I wanted to touch on there as well is that, so as you said, I'm a proponent of taking out the grant money when someone's going to school. So take it out as fast as you reasonably can without putting them in a higher tax bracket.
Exactly.
So really there too, you just want to make sure you're communicating with your kids, because if they, while they're going to school, you can get that grant money out. What if they drop out unexpectedly? What if, whatever happens? So you just want to have some communication there, as well as if they're thinking about maybe not pursuing post-secondary, maybe something like that, just letting them know that, look, I've got this bucket of money over here sitting for you. A portion of it we cannot get out unless you go to some school in some capacity, right? That has to go back to the government. So why don't you take one or two part-time classes over here at at whatever, and see if we can't get that out. So that kind of leads me to two other things. One is that it's easier on our end to get more of that money out faster if they're going to school full time, but can
Oh,
still be. Sorry, go ahead.
actually, let me just interject one thing there, Ben.
Yeah.
We actually have had not many, but we have had one or two cases where people did exactly what you were just talking about there. The kids weren't planning to go to any post-secondary, but because there was this whack of money, they did actually register. I don't know that they registered and got enrolled, I should say. So they had to pay for the classes. I don't know if they actually attended any, but they were registered and enrolled, and that was sufficient for us to be able to pull that money out.
Hmm. Yeah. Well, exactly. If a part-time course
Yeah,
costs $900 and you've got 10 grand in government grant,
yeah,
right? And you can
that's
get that
right.
out by
It's
going
worth
to
it.
school, it can definitely be worth it. So then the other thing that I wanted to mention was just that the bar for being a post-secondary institution is actually also reasonably
Yeah,
flexible. It's not as though they have to go to university or anything like that. There are a lot of community college, vocational schools, training programs, things like that are able to be used for it. In Canada, they actually make it easy. Like if the school's in Canada, there's a list of qualifying institutions that count for it. Outside of that, it's just, there's some rules about they have to be going to school for, I don't think it's even that long. It's like a 6 week program or something like that. There's some rules around what that must look like. But yeah.
well, and along that front, so a lot of times I hear from people saying, "Oh, well, my kid's going to go to a Christian university. They won't be eligible," and or a Bible school, I should say. And an interesting thing with that is that's not strictly true. They may or may not be eligible. When we look, and there's a list. You can go online and look at it, or if you're a client of ours, reach out to us. We can look up the name for you. But what it seems to come down to. So we had one child go to Bible school in Abbotsford, and it was eligible. Why was it? But other Bible schools were not. From what I can discern, the because that school had a program that was not strictly religious, they had an early childhood education program. Because they had that program available, they were granted the ability to be part of the RESP program. Now, kids did not have to attend that program. They just had to attend that school.
Yeah.
And so it's, again, just speaks to the flexibility. Don't assume that just because the school they're going to doesn't sound like it fits the criteria, don't assume that it's not eligible. Look it up, or get us to look it
Mhm.
up for you, because lots of them are.
Yeah, and another thing too, in terms of like the withdrawals and things, this is something that we do for our clients that I'm not sure anyone else does. I haven't really heard of anyone else talking about it. Totally legit and doable, but is that let's say you're in a situation, and we have plenty of clients that we've done this for, where we opened a family RESP for them. One child is old enough to go to school and is going to post-secondary, and we're doing withdrawals for them. Meanwhile, at the same time, they've got other children who are young enough to still collect grant money. And so what we can do is we can say, okay, for this older child, let's, pull out whatever you need for their schooling. That's totally fine. But let's pull out an additional 5 grand, 10 grand, whatever it is of your original contributions. That hits your bank account. And then over here, you've got other kids who can collect money. So collect grant money. So let's take that same 5 or 10 grand, put it to your bank account, deposit it right back into the same RESP. Ta-da! You collect an extra 2 grand in grants if it's 10,000 going in. So yeah, it's kind of a way of recycling your contributions to get through and continue collecting grant money. Again, I don't know of anyone else doing that, but that is
It,
one.
it's one of my very favorite little tricks, and I'm almost afraid to put it out there because I don't want CRA or I guess it's HSRDC to actually even know that it's a little hack, but it's awesome, and it is great. I first did it when you guys were in school, and I thought this is too good to be true, and so we adopted it and started doing it for all of our clients. I think the biggest one we had was, what was it, like 10 kids, and Um,
Like the biggest one I know of is 6, but still,
six,
it's so it's you're pulling out 5 per 5 kids. The
pulling out 25 grand
exactly
and
25
picking
grand
up 5 grand free money that you wouldn't have gotten because you didn't have the cash, right? Like 5 grand a
Mhm,
year that person got, right?
mhm,
It's
mhm,
awesome. So anyhow, yeah, one of my favorite little hacks, something that can
mhm,
be done. But
mhm,
yeah, I also I've never heard of any other advisor promoting it, but it is 100% black and white legit.
mhm, mhm. Another piece too. So we talked about the 20% grant that everyone's getting. This is the Retire in BC podcast, so probably most of our listeners are in BC. Here we have a special provincial grant as well. It's called the BC Training and Education Savings Grant, or BCTESG, bit of a mouthful. But that is, if you live in BC, there's a one-time 1,200 grant per beneficiary that just goes into the RESP. Again, that's not based on any matching or anything like that. So even if you're unwilling to contribute to your kid's education, if you don't have the funds or you're unwilling or whatever, you still want to be opening up an RESP for them to collect that grant. Now that's only available in between the ages of 6 and 9 for each beneficiary. But just thought I'd mention it. I
But
don't.
it's only a one time. It's
It's
not
a, yeah,
it's
one
not
time
each year
each.
between those ages.
Correct.
It's
Yeah.
yeah. But
And I
you
don't
gotta apply
think
for it. You gotta apply for
you
it
have to
before
apply.
they're 9, because
Yeah.
otherwise it's gone. Yeah.
And correct me if I'm wrong. I don't think other provinces have something similar. I think one or two do. I think Alberta might have something, but most of the other
Yeah,
provinces, like
most
this,
don't, but there are some that
it's a
and I'm
very
not sure
unique
which,
to
but
BC
yeah,
thing that
yeah,
we have that.
yeah.
And then, yeah, just wanted to touch on as well. I mean, we've touched on it already, in that you can pull out your original contributions for yourself. But just I do want to touch on it from a retirement planning perspective, because oftentimes, it's a game of trade-offs in terms of a lot of the time, the people with young kids who would be thinking about saving for their kids' education, they've got this competing priority of, we've got our own retirement to think of, and how are we going to save for that? So just, I do kind of like to highlight there again, in most cases, I found that parents want to use the original contributions for the kids. They're thinking of the whole bucket of money as, what, this is for the kids' education. But if you are riding that line a little bit, or, if the retirement fund isn't looking so healthy, all of your original contributions that went into the plan, you can treat the grant and growth money as for the kids, and you can pull out your original
Right.
contributions right back and put them straight into your retirement funds, and keep them, to top that up as well.
So
So,
I like to tell people, think about this like it's double dipping, because that's really what it is. If you can come up with 36 grand over the course of 18 years, you're going to pick up 20% on that $36,000. That's going to go into the RESP. Then you pull that. Now, again, assuming that the child goes to some post-secondary, um, you're going to get to keep, or you're going to get to pass that 20% onto them, plus the growth. You're going to get to pull that $36,000 out. You've gotten 20% grant. You've gotten 7 grand, 7,200 bucks from it. You're going to pull it out, roll it in, or take that money and put it into your RSP. You're going to pick up another 20, 30, 40, maybe as high as 50%, because the odds are you're going to be in a higher tax bracket now than you would have been when you first had the money, when you first put it in. So you're double dipping. You're getting it first for the kids, and then you're getting it for yourself. So 110%. Yeah,
mhm.
if money's a bit tight, it's almost better to prioritize. Again, it depends situationally. If you're in a really high tax bracket today, maybe the RSP is still the better deal for you. If you're trying to buy a house, maybe the FHSA is still a better deal for you. But if you're riding that line, there's a very good chance that it's a better deal for you to contribute
Mhm.
to the RESP.
Well, and on the student side as well, right? It's that if you've got more money than you need in the RESP that's going to the kid, right? If they have other uh, funds, or if they're able to get student loans or whatever, and you've saved quote unquote too much in the RESP for their schooling, well, so what? We already talked about that doesn't need to go specifically for
That's
their
right.
schooling expenses. They could pull that money out. They've started generating TFSA room once they're 18. They could start putting in the first home savings account that's out now to start, saving for a down payment. So it can be very flexible too, and really set them up for success. Even though they're called education savings plans, you don't have to use the money for that. They just need to be going to school. I did want to circle back too, because I think we skipped right over What if they don't go to school, right? And that's
Right.
a
Good point.
very
Yes.
critical piece that we should probably circle back to. So yeah, Arnold, what happens if they don't go to school?
Well, so let me just jump back now to pre-1998. If they didn't go to school, basically all that grant money went back, and and you got taxed really heavily on the growth. Um, so it's, again, or sorry, there was no grant money, and you got taxed really heavily on all the growth. You would have been better off just keeping it and investing it yourself, even better in an interest account. Today, there's a lot more options. The first option is hopefully their sibling is going to post-secondary, and you can just roll it to them. There are some limits about how much of the grant component, that's 7,200. There's some caps. Any one given child can only take 7,200 out of the plan. So if you've got two kids and you got a total of 10 grand worth of grant, and only one goes to post-secondary, there is 2,800 bucks you're going to have to give back. But that 7,200 can go to either one.
Yeah, well, and it's a bit more complicated as well because it's always rolling in the grant and growth together in
Yes,
that
yeah,
case,
when
and
you're
and we're
taking it
pulling
out.
out on a prorated withdrawal, so it's really hard to tell, exactly how much. But to your point there, it's like I have often seen getting 7,200 of grant money out. That's 30,000 of grant and growth. Like oftentimes the
Right, that's
growth
right.
money has
Yes.
really, really
Yeah.
dwarfed the amount of money that you or the government has put
Yeah.
in. And so don't think of that as being that limiting per se. There's still oftentimes a lot of money that can get out. But
Yeah,
sorry, yeah,
yeah,
go
but
go
yeah,
on there.
but basically, if one child doesn't go to post-secondary, hopefully you roll that money over to the second, or third or fourth or whatever it is. Um, if none of them do, then assuming you have RRSP room, so you do have to plan for this a little bit. If they don't go to post-secondary, the grant money has to go back to the government. So think of this as three components. You've got your contributions, you've got the growth, and you've got the grant. And again, as Ben said, when we're pulling it out, they lump that grant and growth together. But when a child doesn't go to post-secondary and you're winding the thing up, then they do actually very distinctly separate it into those three buckets: your contributions, the growth, and the grant. So the grant, if nobody's going to post-secondary, the grant's got to go back to the government. They take it. Your contributions, well, you've already paid tax on it. You just get to take them, no problem, no restrictions. So that leaves the growth component. And with that, the most common option, there are some things if kids are disabled and other stuff like that. So we won't get into that. But really, as long as you've got enough RRSP room, because it will use up RSP room, you can roll that into your RRSP, and then basically it's a wash. It gets treated as taxable income, but you get the RSP deduction. The worst case scenario, if you don't have the RSP room, you can take that cash back, that growth component back, but in that particular case, you're going to pay tax on it, plus you're going to pay a penalty tax. So we actually have had not many, I think one or maybe two cases where the person decided they wanted to take the cash, but we looked at it and it was just made more sense. We rolled it into an RSP for them. They were never going to use their RSP room. We just rolled it into their RSP and then took it out of the RSP. So we ended up avoiding that penalty tax.
Yeah.
So it can happen. We've very rarely seen it happen. But again, lots of flexibility, lots of different options.
Yeah, even if you're planning on spending it, like rather than pulling out that growth and spending it, like you say, if you just do that, you pay you pay income tax on it at whatever your marginal tax rate is, plus an additional 20% penalty tax. Like it's huge. You really
Yeah,
don't want to be
yeah.
doing that. If you have any RSP with room, if you have enough, you roll it into the RSP and then withdraw it from your RSP, and then you're just paying tax at your marginal tax bracket, not paying the penalty tax.
But that won't work if you have zero RSP room, or
Correct.
if you're a senior and you also don't have the ability to contribute to an RSP. So like if you're older than 72.
Yeah.
So
Which again then just highlights what we talked about before, and that maybe communicate with the next of
yeah,
kin and just say,
exactly.
hey, here's the situation. I've got this money set aside. Really thinking you should maybe enroll for some classes somewhere so that we can start using that for both our benefits.
Yeah.
So.
Yeah. No, so glad you brought that up then. So what are some common mistakes and misunderstandings about RESPs?
Yeah, well, I think just not starting early enough, right? Every year that you delay makes it harder to max out the government grants and things. I think probably most of it just has to do with collecting those grants and things like that. If you put too much in a year, then you're not collecting grant on that money. Um, things like that.
Do you know what, actually, on that point, I'm going to add here, um, there's almost no excuse now to not get started early. When these things first started, again, I'm going back in history here, but when they first started, kids didn't automatically have a social insurance number. It was a bit of a procedure to apply for a social insurance number. And so when these things, when I started out in my career, if somebody wanted to open up an education savings plan, the first step wasn't doing that paperwork. The first step was applying to the government for a social insurance number for the child. I forget when they did this, but sometime late 90s, I think, maybe it was early 2000s, they started to automatically, every time a child is born, um, at least if they're notified. So if they're born in a hospital, then automatically a social insurance number is generated. So it's a lot easier today to open these things up. You don't have that pre-step to do, um, and so it's just a matter of coming up with
Yeah,
that
well, and
200 bucks a month.
I think even they're arguably too easy, maybe in that I have heard, and I haven't really vetted this or looked into it too much, but I have heard that when you have a child born at the hospital, oftentimes there's a little, there's a form that you're filling out and there's a checkbox. I'd like to be contacted about getting an RESP, and then you get hounded by these providers to open a group RESP, which is different than what we were talking about before, which is the family RESP. I have heard that those are awful, most of them. Again, haven't really vetted this. I don't want to speak too much to it, but I've just heard that administratively and the way that they are set up, and they may or may not be as good as just doing it on yourself for a family RESP. So definitely, I think it's worthwhile chatting with us or chatting with someone else, about doing that. Maybe be wary of
Certainly,
those
yeah,
group ones.
certainly the ones of those that I have looked at have, for the most part, been really, they've been restrictive, almost not as bad as pre 1998, but almost like it's been kind of brutal and expensive if you close them out early and hard to get the money out. So
Well,
yeah,
it's like it's a pooled investment
yeah,
you're pooling
yeah,
with other people,
yeah.
and then yeah.
Yeah, I think they're typically called university scholarship funds, but I don't think that's the only type that way. But yeah, I know what you're talking about for sure.
Yeah, yeah. But yeah, other than that, I mean, just be conscious of how you're doing the withdrawals. If you're trying to do a withdrawal and your financial institution doesn't ask you for a proof of enrollment letter, watch out for that. The other thing too, actually, that I'll just mention on the withdrawal front is that it's a little bit funny in terms of the timing of them, because what we need is an official proof of enrollment letter stating that the child is enrolled for classes. Typically, before that's happened, you've had to go apply for schools
Right.
and oftentimes had to already come up with the tuition payment or a deposit. We cannot yet get the money out because we don't have the proof of enrollment. So just sometimes they are like, don't necessarily rely on being able to get that out immediately. Oftentimes we're waiting until they're actually enrolled. Typically that's a few months before the semester has started, but there just can be that little bit of a stopgap timing wise,
Well, and people often
getting the money out.
confuse registration with enrollment, right?
Correct.
Like you register first and then you get approved. And then you may be registered with three different schools and only end up
Yeah.
enrolling with one of them. And it's that enrollment. So that proof of enrollment letter.
And most schools make this really easy. Usually now the student can go onto the student
Yeah.
website and click download my proof of enrollment,
Yeah.
and
Yeah.
it just generates a letter that that we need. So
There's a few schools they still have to go to the registrar and ask for a
right.
letter.
Yeah. Yeah.
Back in the day, again, I know I've been talking lots about history, but we used to actually have to piece little bits and pieces together because there was no standardized system for it, and we'd have to get one document that had um, the number of hours they were going to school, but we had to make sure it had the school's logo on it, and another document that said they paid, and another like it was like we'd piece together 2 or 3 documents and make sure that they clearly were they had matching information so that we could confirm that this was all part of the same.
The address and signed by the registrar. And
now in most cases it's easy. Yeah, the kids just go on, download, and away you go. So
So anyway, that's mostly it. We absolutely love RESPs, both for the education planning and also just as a tool for intergenerational wealth building.
Saving for that Harley.
Saving for that Harley. So really, whether it's the goal is estate planning or saving for their education or your own retirement, like they're reasonably flexible in a few different ways. Love them for that. Thanks everyone for listening to this episode of the Retire in BC podcast. Helping the next of kin, your kids or grandkids, with their education is one of the most meaningful financial goals there is. The RESP is one of the best tools Canadians have to make that possible. If you found today's episode helpful, please make sure to follow the show and share it with a friend or a family member who is saving for their kids' education. Thanks for tuning in, and we will see you next time.
Thank you.
The views and opinions expressed in this podcast may not necessarily reflect those of IPC Securities Corporation or IPC Investment Corporation. The information provided is for informational and entertainment purposes only and should not be construed as financial, legal, or tax advice. The hosts and creators of this podcast assume no liability for actions taken based on the content discussed.